see. Okay, so next one, this one's pretty interesting. How do we determine product selling price using cost data? And so this is more qualitative, so I'm not going to go into the money, the formulas for a little bit. This is really relevant because I use this in my job every day. We talk about pricing. So this is something that you use the rest of your career. So don't forget about this lecture. The pricing decisions are how should I determine what should I determine my product should be valued at? And so, like I said before, like I think from a service perspective, I'm an accountant. And I'm a consultant, and I'm a business coach, and I'm a teacher. I can sell all those services for different prices. I can sell my consulting service for a premium, sell my accounting for less, but ultimately I get to decide what those prices are, right? It's my time. I can decide to sell all of it for $10 an hour, or I could decide to sell it for $200, $300 an hour. If I price it differently, I'll have a different perception in the marketplace, and I'll have a different demand in the marketplace. If I charge $1,000 an hour, maybe one person wants to hire me 1 hour a week or 1 hour a year. But if I charge $10 an hour, maybe I have an unlimited amount of time that people want to pay me for that. But the healthy ground is somewhere in the middle, and I have to evaluate a lot of other considerations. So first is target profit. So what do I want to make? So if I need to make $100,000 a year, I can't make, I'm gonna make some calculations around this. If I want to make $100,000 a year, pricing, and I have 2,000 hours in a year. So we'll say 2,080. That's 40 times the number of weeks in a year. So no PTO, no vacation. So time and pay, or hourly rate. You can do this for products too. I just think it's easier to visualize with. So if I want to, and I want to say I want to make 100,000 a year, 100,000. That's one way I could go about it. So if my time is, I expect to work every week, 40-hour weeks, no vacation, and I only charge $10 an hour, I'm only going to make $20,800 a year total. So how much do I have to charge in order to make $100,000 a year? I have to charge at least about $50. And so that's one way to do it. So I could calculate it and then see my difference. So, okay, I have to charge at least $50 to make my at least $100,000 a year. And I can also change this time. Maybe I only want to work $1,000 a year, right? 1,000 hours a year. Then I'd have to work charge $100 an hour. So we could play around with these variables to decide what my target profit is, what I expect to return on my investment. I could build in costs here as well. This is just high level how we can go about pricing. Customer demand though, what if when I charge $100 an hour, there's less of a demand for my services? So let's say I charge $100 an hour, but now only people want 1,000 hours, 500 hours of my time. That's not going to help me either, right? So we need to find a nice balance of how much time I can put in and what our customer demand is. Then we have to care about my competition. What if I'm charging $200 an hour, but all my competitors are charging $50? People are probably, if my competitors are the same quality, people are probably going to go to the competition. Differentiation. Maybe my competitors are charging $50 an hour, but maybe I have an expertise. Like I'm a revenue subject matter expert for software companies. That's something I'm particularly good at and no one else can do. So maybe my premium is worth it. So I have more control in setting my price because not a lot of people have the expertise that I have. And then product life cycles. So we might want to consider, well, if a product has a relatively short life cycle, we might think of phones. Maybe we can charge them for a lower cost. But we know that even with the new iPhones and all the phones coming out, they're getting more expensive because people keep buying the new models. But generally, if they have a shorter life cycle, we'd expect to be able to charge something a little cheaper. Another method, so these are all customer facing. We should look at this from a comprehensive standpoint. We can also look at a cost plus model. We might say that we expect to make a certain markup for every single product we sell. So I might say, I'm selling phones. It costs me $40 to make a phone, or maybe $100 to make all this hardware on the phone. And all my competition makes 100% margin. right? So we can call it 200. We can just multiply this out to get our $200. So that's our cost plus margin. We say we expect to make 2 times whatever we paid for our phones in order to determine our markup. There's also something called the total cost method. So we can determine what the total cost of the products are, and then determine how much markup we want per unit in order to determine our total cost per unit. And so that's, I'll put it over here. And so the thought here is total cost method. Total cost method, we're saying product costs, $10 per unit, or $44 per unit. How many number of units? We're saying 10,000. That's 440,000. Plus we have fixed selling and fixed overhead costs of 140,000. And we have selling and administrative costs of 60,000. And we also have variable selling and administrative costs of 6 times this. We have the variable selling and admin. We have the overhead. We have the selling and admin. That's our fixed, variable. And this is our product costs. And so question here is how can we determine our total price per unit? Well, we're going to take our total costs that are relevant here. And so our total relevant costs are 580 and our selling and admin are 120. So we have a total cost of 700,000. So our relevant costs here, right? We're assuming our variable and our fixed, these we're expecting won't change, are 200. But because we're trying to figure out the price we want to charge, we care about the relevant and avoidable costs as well. So we're looking at both, even though we can break it out. This is relevant, unavoidable, sunk. It's still our total cost, and we want to make a profit on our total cost. And so we're saying we want a 20% markup. So, oops, 20. So the 700. What's our per unit? So our 700, we have 10,000 units per unit. What's our markup we want? A 20% markup, which is 14. Markup percentage, markup dollar. And then we add this to our total cost per unit. And this is we get our final price. So that's another way that we can determine pricing.